Good evening once again, everyone. It's good to have us on board. So in today's class, we are looking at solvency, coverage, and investor ratios. So in our last class, we looked at profitability, efficiency, and liquidity. So these are the other ratios that we'll be looking at today before we continue the class. So our learning objective is that by the end of today's class, we should be able to assess solvency. We should be able to um, compute ratios, master leverage, coverage, investor ratio calculation, applying the dew points, then also detect change, like using common size analysis and also trend analysis. All right, so solvency. Now, when we're talking about solvency has to do with the ability or the capacity of a company to meet its obligation in the long term. Yes, solvency has to do with the company's ability to be able to meet financial obligations in the long term, most likely extending beyond 1 year. So liquidity look at the short term, while solvency looks at the long term. And now, when we're looking at solvency, we're looking at the debt of the company or the debt of the business. So we're comparing the debt with the equity of the business. So we want to know what's the proportion of debt to equity. So that is actually what solvency is. So solvency also tells us about how sustainable the business is, how sustainable the capital structure is. Now, if a business has more debt than equity, there is financial risk. So the financial risk is if the business does not perform well, that business may liquidate because they will not be able to pay interest. And the moment they're not able to pay interest, the creditors are not happy. The financial institutions that provided loan for the company, they won't be happy and they can get hold of the collateral security. So imagine if the company used his property as a collateral, for instance, and they defaulted. What that means is that the bank would actually take ownership of the property. Yes, and that would also affect the company. So solvency help us to look at how company manage debt. Yes. So we have different ratios that we'll be looking at today. So we have the debt to equity, which is the first one. So as the name implies, we are comparing the debt and the equity. So yeah, anytime I mention debt, let's take note that we're talking about interest-bearing debt. So these are debt that you pay interest on. So and most likely they are the non-current liabilities of the business. So debt to equity, we are looking at the proportion of the debt to equity. So like how many percentage of equity is your debt? So if equity is 20%, that is good for the business. If debt is 20%, that is good for the business. But if the debt is 60%, that is not good. So that is not good. If the debt is 60%, that is not good enough. So debt to equity. Now, your debt, you're comparing the debt to equity. So that is just that. Debt to total assets, we're looking at, okay, comparing the debt with the total assets. That's another way to measure the solvency of a business. But you are looking at the asset base. You are comparing the assets with the debt. Now, the next one is equity ratio, equity divided by total assets. So now equity over total assets, you're like, oh, this total asset is financed by equity. How many percentage of your total asset is your equity? Now, if equity is 70% of total asset is good. It then means that your debt is 30%. It then means that your debt is 30%, which is actually good for you. So capital gearing is also another solvency ratio that actually help us to check the long-term debt capital and how can we place reliance on our long-term debt capital. So the formula is long-term debt divided by long-term debt plus equity. So long-term debts divided by long-term debts plus equity. So we call this debt to debt and debt over debt plus equity. So that's the capital gearing. So yes, so if a company is highly geared, it means that the company is the company has more risk. The company has more risk. So yes. So if you look at debt to equity is like using equity as a baseline and comparing debt to equity. So if your debt to equity is 100%, it means that your debt and equity is the same thing. If your debt to equity is 100%, it means your debt and equity is the same thing. So debt is 100% of your equity. Yes. But if your debt is lower than 100%, the debt to equity is lower than 100%, still good. It's still good for the business. Yes, although it shouldn't be too high. So if it is 20%, 30%, 50%, it's still good. So it means that your debt is half of your equity. So if that means if your equity is 1 million, your debt is 500,000, which is still good for the business. So that is how we look at debt to equity. So debt to total assets is comparing the total assets. Debt to equity to total assets, comparing equity and total assets. Then capital gearing, comparing the long-term debt divided by long-term debt plus equity. So that's just that about the ratio. Okay, so this is a case study. Dangote Cement PLC. The financial position is showing a total debt of 1.4 trillion and the equity is 2.4 trillion. Total asset is 5.6 trillion. So our debt to equity ratio for this company is going to be 1.4 divided by 2.4. Yes, and if you do that calculation, we get 56% or 0.56. So 0.56 is a moderate leverage, which is saying that, okay, our debt is like almost half of our equity. Yes, almost half of our equity. So that is actually that. Now, for the debt to assets is looking at, okay, the debt, 1.4 trillion divided by total assets is 5.6. If you divide, that gives you 25%. So which means that your debt is one quarter of your assets, which is still reasonable. So if your debt is one quarter of your assets, you're still good to an extent. You're still good. So equity ratio, on the other hand, you are comparing the equity to you are comparing the equity to total assets. So that's 2.48 divided by 5.68, which gives us 44%, which gives us 44%. And 44% is close to half. So which means that your equity is almost half of the business. So that's that. Although this is still fair, but the company can do better in terms of solvency. The moment if your equity ratio is below 50, it can be very, very risky. So now we have the capital gearing. Capital gearing, we're looking at the long-term debt divided by long-term debt plus equity. So that is your capital gearing. And the capital gearing, we say that is the 1.4 divided by 1.4 plus 2.48. That gave us 36%. So that is okay, also moderate. So you can report your solvency using any of these ratios, In a situation whereby you need to have compute solvency, you don't need to use all the four solvency ratio. You can just use one or two. Yes, you can just use one or two. But you also need to look at the one that best suits the business. The one that best suits the
Process.
business. So exactly. So that is that. Now let's look at our coverage ratios. Coverage ratios. Now, when we're talking about coverage, we're looking at the debt serving capacity. Yes. Now, our coverage ratio measures how
Sorry, sir.
comfortable. Yes, sir.
Uh,
You have a
Can you
question?
just give me like 5 minutes? Let me turn on my gen. The laptop is running.
Oh, no
It's running.
problem. I'll wait. No problem, sir.
Yeah.
Okay. All right. So we're looking at coverage ratios, and when we're talking about coverage, um, it's actually looking at it's the business, like the debt serving capacity of the business. So the coverage ratios that we have measure how the earnings can meet the debt obligations. So if you say you have debts, how can your profits be able to meet your debts obligations? So so you trying to compare your profits with your interest. So most of these coverage ratios, you're trying to look at your interest and your profits. Yes, your interest and your profit. That's what we are looking at. So the one we are familiar with is interest coverage. The one we are familiar with is interest coverage. And so we have other one like debt service coverage ratio. Then we have the fixed charge coverage as well. So so that is that. That is that. So now these coverage ratios, they signal the financial distress risk by showing whether operating profit sufficiently covers the interest and also the principal payment. So you are like, okay, operating profit is your profit before interest and tax. And you are trying to see, okay, comparing the profits with the interest. Now, you should have over 100%. This ratio should give you over 100%. The moment it's less than 100%, it means that it's risky for the business. It's risky for the business. It should be way higher than 100%. So the interest coverage ratio, the debt service coverage ratio, then the fixed charge ratio, these are the different ratios that we have. Now, the rule of thumb is that your coverage ratio should be uh, above 3 times. So if you have your coverage ratio, which is above 3 times, it's telling us that your business is very, very healthy. But if your coverage ratio is less than 3, if it is 2, still fair, it is 1 is very like risky. 1 is 50-50. That means your profit is exactly the interest you are paying. Because if you say 1 divided by 1 is 1, or if you say 50 divided by 50 is 1. So if your operating profit is 50, profit before interest and tax is 50, and your finance cost is 50, it's not good, which it means that your profit after profit before tax will be 0. That's what it means, and that's not good for the business. You have not even removed tax. So if you remove tax, that would be a loss. So in short, okay, if you don't have if your profit is 0, you won't pay tax. Okay, that's another way to look at it. If your profit is 0, you won't pay tax. So so that is just that. Now the debt service coverage ratio is you looking at your operating profits plus depreciation. So you're adding depreciation back to the operating profit. Then you are dividing it by the total debt service. Total debt service. So now, looking at this, the debt service coverage ratio, you're able to what? Service the interest and the principal. You're looking at the ability of the firm to service the interest and the principal. So now we have the fixed charge coverage. The fixed charge coverage, we are looking at the fixed charges. Now, fixed charges include maybe fixed interest payment. Like, for instance, if you have 5% loan note, it means that so far you have that loan, you have to pay 5% as interest. If you have 10% preference shares, so that preference shares is like an hybrid instrument that can be seen as equity and also a debt instrument. So if you have a 5% preference share or a 10% preference share, it means that you would have to pay the owner of the preference share 10% dividend. So which looks more like interest also. So for the fixed charge coverage, you're looking at all the fixed interests. So your operating profit plus your fixed interest divided by your fixed interest. So you are looking at your ability to cover all the fixed obligation. So now, so that is that. If your coverage ratio is going down, downward trends signal early warning signs, especially if the interest rate is increasing. If the interest rate is increasing, the moment your interest coverage is reducing, you need to be very, very careful because that won't be good for the business. So it means that you don't have enough profits to pay back the interest on the debt. That's what the coverage ratio is looking at. Do you have enough profit to pay the interest? That is what the coverage ratio is looking at. All right, so let's look at this coverage ratio in practice. Dangote Cement. Interest coverage. Now, if operating profit is now 103 billion, if your operating profit is now 103 billion and your interest cost is 200 billion, then that means your interest coverage is 4.5 times, which is a very strong position. And it means that you have a low risk. You have a low risk. So that is good because the industry's expectation is, okay, your interest coverage ratio should be three times. So if it is above 3 times, it's good for the business. It's very good for the business. Yes, you can confidently deduct 200 billion from 903 billion. You are left with 703 billion, which is still good for you. And you can still give out dividends to shareholders after interest has been settled. Now, the debt service coverage ratio, you need to add back depreciation. You need to add back depreciation. So let's say that depreciation is 300 billion. Okay, after adding back depreciation is 300 billion. After you've added back depreciation is 300 billion. The company covers total debt service is 350 billion. So that is 3.4 times. I'm coming. After adding back depreciation, so if you go back to check the formula, is operating profit plus depreciation divided by total debt service. So your total debt service is 350. Your total debt service is 350. So if you say 903 plus 300, yes, if you add 300, if you add 300 to 903, that's 1,200. 1,200 divided by 350 is what? Let me press my calculator here. 1,200 divided by 350. Yes, that gives us 3.4. So yes, that's how we got the 3.4 times there. So we're saying that our depreciation is 300. We're adding the 300 back to the 903. That gave us 1,203. So 1,203 divided by 350, which is the total debt service. The total debt service is 350. That gives us 3.4. Now, the minimum threshold for debt service coverage ratio is 1.5. So 3.4 times is much more better. Yes, it's actually better. So that's that. So this is saying that Dangote Cement can meet obligations from operating cash flow. Yes, and analysts must monitor trend closely as interest rates and commodity price fluctuate. Now, this debt service ratio or coverage ratio is helping us to check your interest. Now, if you are paying interest on debt, the end goal is to make profits. If you are not careful, if the loan does not favor you, you may not make profit though. So your coverage ratio is looking at, okay, after you've incurred this interest, are you still going to make profits? Nevertheless, that's what the coverage ratio is looking at. So yes, so that's just that. That's just that. Yeah, so now investors ratio on the other hand, help us to check for the company's performance and match it with shareholders' expectation. Yes, connecting the shareholders' expectation with the profitability of the business. Yes. Now you're looking at the accounting profits, the market valuation, to also review the profitability, the dividend policy and also the growth potential of the business. Now we have different ratios for investors ratios. We have the EPS, which is earnings per share. We have an accounting standard for that is IAS 33. So your earnings per share, as the name implies, earnings is your profits, profit attributable to your shareholders. Most likely this is a profit after tax. Your EPS, you use your profit after tax for your EPS divided by ordinary shares. EPS, profit after tax divided by ordinary shares. Then your dividend per share, you're comparing the total dividend divided by the shares. The total dividend divided by the shares. Then the payout ratio is a combination of DPS, which is dividend per share, and your EPS. So you are dividing dividend per share divided by EPS to get your payout ratio. Now, this will help us to know, okay, your dividend compared to your earnings. Yes. So if the dividend per share is very high, it means that if the payout ratio is high, it means that the company is paying more of the profit to the shareholders. And investors would like to invest in such kind of company. Wow, if I invest, they are going to pay me most of the return will be paid to me as dividend. Imagine if a company pays 80%, if payout ratio is 80%, what I mean is that they've paid 80% of profit for that year as dividend, which means the retained earning is just 20%. So yeah, investors will most likely be interested in this kind of company. But if the payout ratio is low, let's say 5%, they say if the company makes let's say 100 million profits, they will only pay 5 million to shareholders as dividend. So that's a payout ratio. Dividend yield is looking at, okay, the dividend per shares divided by market price times 100. That is what the dividend yield is looking at. Then the PE ratio is looking at the price earnings, the market price divided by the earnings per share. So we call it price earnings ratio. You are comparing the price of the shares with the earnings of the shares. Yes. This price now, if I release the price is how much you are paying to buy the shares divided by the earnings the shares will give you. So yes, if the earnings is higher, so that is if this is less than 1, it means that the earnings is higher. And yes, investors will most likely invest. Yeah, so that is just that. So this ratios are to help investors to make decisions as to whether they should invest in the company. All right, so quickly, we'll look at the DuPont analysis, and we'll also look at common size reporting. Yes, and here we'll be able to break down the returns and detect structural change. Now, when we're talking about the DuPont analysis, the DuPont analysis help us to decompose our return on equity into three drivers. So we're looking at the return on equity. Return on equity should be profit after tax divided by equity. Yes, profit after tax divided by equity. Now, we are saying that the DuPont analysis is stating that your return on equity is a breakdown of what? Operating margin, your asset turnover, and your equity multiplier. Yeah. DuPont analysis is saying that your return on equity is a breakdown of operating margin. Operating margin is your profit before interest and tax divided by revenue. Your asset turnover is revenue over total assets. So that's looking at it from the perspective of efficiency. Revenue over total assets. And equity multiplier is you are looking at equity. So at the end of the day, the DuPont analysis is telling us that if you combine your operating margin, your asset turnover, and equity multiplier, you should get return on equity. So that's what the DuPont analysis is all about. So we can make further research before our next class. I think I would explain this more when we meet next. Yes, so the next is actually the common size statements. So common size is using a line item as a percentage of a key figure. Now, you are going to use all the line items and compare it with a base. The base is always the highest figure on your financial statement. So if you look at the P&L, what is the highest figure in your P&L? The highest figure in your P&L should be what? For a company that is profitable, what should be the highest figure in the P&L for a company that is profitable? I know we have revenue, cost of sales, gross profit, distribution cost, admin expense, profit before interest and tax, our interest, finance cost. We have investment income. We have profits before tax. We have our tax and profit after tax. Out of all these, which of these will most likely be the highest figure for a company that is making profits? Are you still there, sir?
Yes, I'm here. I'm listening.
Okay, so did you get the question, sir?
Try to the question again, please.
Okay, so the question is how many in your P&L, which of the line item has the highest figure in the P&L?
What's that? Normally, it should be revenue.
Yes, thank you, sir. So for a company that is making profit, it should be revenue. So when we're looking at the common size analysis, we are comparing, in the P&L, we are comparing everything with your revenue. So we are like, okay, your cost of sales, how many percent of the revenue is your cost of sales? So that's common size analysis. Your profit before interest and tax, how many percent of your revenue? Your admin expense, how many percent of the revenue? So that's common size analysis. Now, your trend analysis, on the other hand, you are trying to compare what happened last year with what happened this year. Is there an increase or a decrease? And for trend analysis, we always use the new figure minus the old figure divided by old figure. So we always use the old figure as the denominator. So the difference between what happened this year and last year divided by the last year figure. That is how we get the trend analysis. So with the trend analysis, we're able to know what has happened so far. So okay, I think this is where we're going to stop for the theoretical aspect of the class. But before we go into the practical aspect, I would like to know, please, do you have any question for me before we go into the practical session?
No, I'm okay.
Okay, sir. All right. So we'll be going into this practical session shortly. So now the common size analysis is what we are looking at now. The common size analysis is what we are looking at. So yeah, we want to compare everything to revenue. For P or here, we are comparing everything to revenue. For the SFP, statement of financial position, okay, even though we call it balance sheets here, but I always like calling it statement of financial position. Yes. So statement of financial position. So our statement of financial position is our total asset that we use to divide everything. So starting with revenue, our revenue, we would say that to do common size analysis is going to be revenue divided by revenue. Enter. Now, if I copy this formula to the left, it still gives me 100%. But what has happened is that this 100% that we have here is one from the 100% we have here. What Excel has done is it has moved. Now, this is on E6. If we check what we have under here too, we cannot have E6. So what Excel will do is we are moving to the right. Excel 2 will automatically move to the right. So if you check, we now have F6. Yes, because this is F. This is column F. So because we have moved one step to the right, Excel is also moving one step to the right. That is how Excel is built. Now, if I copy this down, it's still showing me 100%. It's still showing me 100%. But meanwhile, showing cost of sales divided by cost of sales. That's not what I want to do. I want it to tell me cost of sales divided by revenue. So in order to be able to achieve that, it means that this is wrong. I can't use this. So I have to modify this, my formula, and tell Excel that, see, for whatever reason, it is only the revenue I want it to be as the denominator. Don't move revenue for any reason. So because of that, I can use my dollar sign to hold revenue. So I ask myself, which row is revenue? Which row is revenue? Revenue is on which row?
Revenue is E6.
E6, that's on row what?
That's uh,
This is the row
yes, now
now.
that's
This is the
yes,
row
that's
that
why
we
I
have
say
revenue. This
row
row is
six.
which row? Row 6.
That's row 6.
So I will tell my Excel, I say that I don't want the denominator should always be 6 for all the uh items. So I can easily tell my Excel that, okay, I use dollar sign to hold the 6. So I put shift 4, which is the dollar signs before the 6. I put shift 4 before the 6. Now, if I put shift 4 before the 6 and bring this down, if I copy it, it has held the 6. Now, the numerator is still changing, like how I change, but the denominator is now just the revenue. So even if I move this to the last, row, if I move this to the last row, the revenue will still
Okay.
be held because I've given it an
Yes.
instruction that old revenue, no matter what, I want everything to be
Okay.
divided by revenue. Is it clear,
Revenue.
sir?
Yes, yes.
Okay, good. So now we can bring this here. Let's check. Now, yes, 42641. So this is now on the year 2. Then we can, now if you come here and press F2, now it's now gross profit divided by revenue. That's good. If we check here, this is net income divided by revenue. So the denominator, you are saying that 6, I want you to divide by row 6. That's why this E6 is there. So yes. So yes. So now, this one, because we did not hold our F, we can still hold our F and say, okay, don't leave F column. But that's not what we want to do. That's not what we want to do. We'll say, okay, move from E to F whenever we're in year 2. Move from E to F. That's why we're not holding F. If not, if we want to hold F, we can also put $ before F. So what I mean is that it's going to hold the revenue of F, which is a year 2, but we don't want to hold revenue of F. We only want to hold revenue in each of the years. So we'll say hold only the 6th row. So if you drag this down yes. So we can just check randomly to check if that ahead. So this is a net income, that's correct. If you check this one, this is on EBITDA line, which is also correct. So it's already choosing EBITDA. So that is correct. So now this formula that we have here, we can copy it and paste it in the whole area. Yes, we can copy it and paste it in the whole area. And automatically we've done our common size analysis. So in short, I'm coming. Let me delete everything here. So with this formula, if I type it here once, I can just copy it and paste it on the other part, and it's going to populate automatically. So that's the beautiful thing about using Excel for your financial analysis. So if you check the net income, we see that this is a profit after tax. Let's call it profit after tax. Profit after taxes. Our profit after tax in year 1 is 4%, year 2 is 4.5, year 3 is 4.5, year 4 is 4%, year 5 is 4.1%. So if I ask, in which of this year did we achieve a better profitability? In which of this year do we achieve a better profit in terms of, let's even look at the EBIT, earnings before interest and tax. In which of this year did we have better earnings before interest and tax? Are you still there, sir?
That's year 2.
Year 2. Okay, good. Year 2. In terms of profit margin, year 2 gives us better in terms of profit margin. Yes. So what I mean is that we're able to minimize cost in year 2. But if you even check it very well, you'll agree with me that in year 5 is where we have the highest profit. That's 3,000.
Yes.
So even though
Yes.
in year 2 we have 2,000. So, but what happened is that our revenue is increasing, but our cost is also increasing, but the cost
Cost.
was increasing in a higher proportion compared to the revenue. So that is what happened. So if you check, the trend is our EBIT ratio was 5.6 in year 1, but it has reduced to 5.4 in year 5, which is really not good enough. So that is looking at it from the common size analysis perspective. So common size analysis, you are trying to compare the revenue with every other line item. So you're trying to say, oh, cost of sale is how many percent of revenue, gross profit is how many percent of revenue, operating profit is how many percent of revenue, and the likes. So that is how we do the common size analysis. So now let's quickly use this to calculate our let's quickly use this to calculate our common size for the statement of financial position. Now, for the statement of financial position, it's supposed to be this divided by this, this divided by this. But we say that, okay, we want to hold row 39. So in our denominator, after the E, we put $sign, shift 4, put $sign before 39 and press enter. Now we can drag this up. We can drag this up. Now when we drag this up, it gives us accurate figure. So 5.9, let's check this 5.9. It should be cash over total assets. So let's check. So yes, cash over total assets, that's correct. That's cash over total assets. So we can just copy this and paste. We can just copy this and paste. Yes, we can just copy this and paste.
So, sorry.
Yes, sir.
Is that okay? The 100 down. Okay, that's the total assets divided by total assets. That's what we did down there.
Yes, total asset divided by total asset is 100%.
Okay, so we now hold that 39. That's
39 column, row 39.
okay.
Yes,
39. Okay.
yes. So now this same formula is what we can use here for our current liability. We use the same formula for our non-current liability. We use the same formula for our shareholders fund equity. Shareholders fund equity. So that's that. Now we can do a random check. We can do a random check by pressing F2. F2 will help you do a random check. So F2 is telling you that, okay, this is a current liabilities divided by assets. So which is good, which is good. So,
Okay.
so that is that. So with this, it will make you to be able to work smart. You don't have to be typing formula one after the other.
One
You'll be
after
able
the
to,
other. Okay.
yes, you'll be able to work smart while you're working on Excel. Now, Excel can do so many things. In short, I was on a call with my MD this week. I built a payroll model using the new tax law, and then he was surprised when I used a formula and I just added a new person to the payroll, but by putting the person's designation, it automatically computes the salary of the person without any stress, because in the back end, I've linked the sheets and linked the formulas and say, okay, if the person is in this position, the basic salary is supposed to be this, supposed to be that. So with that, you're able to manage and work smart. So if you know how to use Excel very well, you'll be able to work smart. You don't have to be spending the whole day on something you can do within 30 minutes. So that's how it is. So imagine somebody that wants to do this now, maybe we'll be taking it one after the other. But me, I will just do one and copy everything and paste. I'm done within 2 minutes. I'm done. But somebody that will want to say, let me do the hard work, we'll be doing this one after the other, and it's going to waste a lot of time. It's going to waste a lot of time. So I believe you're able to understand this much better, the common size analysis. Is it clear, sir?
Yes, it's clear.
So now in the common size analysis, the interpretation is also very, very important. So like from here, we can say that the company performed much better in terms of profitability in year 2. Yes, the company performed better in most of these. The company performed better in year 2, actually. From what I'm seeing here, the company performed better in year 2. Now, the reason is because year 2 has the highest. Year 2 is part of the year that has the highest gross profit. So the highest gross profit was achieved in year 2 and year 5. Year 2 and year 5. The EBIT, the highest EBIT was in year 2 also, 6%. Highest EBIT was in year 2, 6%. The income before tax is 6.3. That's the highest in year 2 also. No other year has up to 6% for the income before tax. Then the profit after tax, year 2 and 3 has the highest. So it's like in year 3, you started by spending a lot of costs,
Yes.
but you
Yes.
ended up reducing your costs at the end. And that also helped you to be able to have the same profit margin, profit after tax in year 3. So yes, but for year 4, you are not able to manage things anymore, and the profit margin keeps declining from year 3. Yes, it keeps declining. Okay, it declined to year 4, then it's peaked also in year 5. So that is how you look at the common size. Now, the common size analysis, now what we have done is we've done trend analysis, we've also done common size analysis. Now, the common size analysis alone, we are looking at what has happened in a single year. So we're only looking at 1 year, what has happened. Okay, yeah, revenue is 100%. Cost of sales is 92.3 of our revenue. Wow, that's very high. Cost of sales is very high.
Yeah.
Very, very high. So it can be as a result of the nature of the business. So there are like all these FMCG companies, their cost of sales is always very high, and their profit is always very small. But because their goods is fast moving, if they sell, if their profit is 100 naira and they sell 10,000 units in a day, 100 naira times 10,000, that's how much? That's in millions. If they sell 10,000 units in a day, that's how much? Yes, that's 1 million naira profits in a day. That's actually on the high side. So 100 naira profits is what you are making. Rather, some business can be making 100,000 profits for a single transaction, but they may not be able to make 1 million in a day. So that's actually for FMCG. That's for FMCG. So yeah. So that is just that. That is just that. Okay, so if you check the statement of financial position, we say that in year 1, our current asset is our non-current asset is 16%. And sorry, our current asset is 16%. Our non-current assets, okay, property, plant, and equipment alone is 70%, which is a very high. Okay, so I think we can include an item here for I'm coming. We can include an item here. Okay, we can include an item here for total non-current assets. Yes, total non-current assets. Total non-current assets. So our total non-current assets, we'll say that this, yes, this total non-current assets. So our total non-current assets is 83.4. But what did we notice? Our total non-current assets is reducing. It reduced up to year 4, but started increasing back in year 5. That's the total non-current asset. Total non-current asset. And what's the implication? The implication is that our PPE is reducing. Our PPE dropped from 70% in year 1 to 68.4, then to 65 to 50. But in year 4, it moved to 52%. So our PPE is the major asset, yeah. It's a major asset here because it's taking 70%. 70% of our total assets. So yes, which means it's playing a very important role there. So that is that. Now, if you check, our current liability is 33.3%. Our equity is what? 41.6%. Then our non-current liability is 25.1%. So we can even use this to compare the gearing of the business. Like, okay, the debts, non-current liability is 25%, but the non-current liability reduced in year 2. So in short, from the look of things, year 2 actually performed so well because the gearing reduced in year 2, but from year 2, it started increasing back. It increased to 26, 33.2, 33.5. So the gearing was increasing. And if care is not taken, the gearing might increase more than this in year 5.
That's
So yes, so that is just that. Then our shareholders' equity, our equity is 41.6. It's increased to 42.4 in year 2. So year 2 has better equity. But from year 2, it keeps reducing. It keeps reducing. In short, it reduced to 28.2 in year 4, but go back to 31.7 in year 5. So from all these ratios that we've looked at individually, it seems like year 2 has like better performance. Year 2 has like better
the
performance.
most, that's the best.
Yes. So that's actually the best year so far. So that is just that about common size analysis. Do you have any questions, sir?
No, no, I'm full with this.
Okay.
I'll just look
So
at it critically.
so yeah, so what I will do, um like the ratios we solved today, okay, I think I'm going to give an illustration and a take-home assignment on this common size analysis. But before we end the class, let's quickly look at let's quickly look at okay, so let me just use this privilege to teach you how to do free spin. Now, I'm having a challenge. The challenge is that my space is filled up. If I want to scroll to the left, I don't know which one is revenue, cost of sales, it's not showing. So I want to do it in a way that what we have up to year 5 here is showing, and I can be able to scroll conveniently without, and I'll still be seeing this. So if I want to achieve that, what option on Excel can I use? What functionality on Excel can I use? Do you have an idea, sir?
Uh, what is it called? You freeze it.
Yes, free spin. So that's what we would use. And for us to be able to use free spin, we want to be showing the years. We want to be showing the years. So we'll come here, that's below here. Now, I want it to show up to this point, year 5, and I also want it to show up to this point. So I want it to show up to column I and up to row 2. Column I and row 2. The next cell after column I and row 2 is a J3, abi?
Yes.
So I come to J3. I come to J3. I click freeze pane. Let me unfreeze first because this was freeze before. I would have freeze. Then I come to freeze pane. So freeze pane, keep rows and columns visible while the rest of the worksheet scroll. Yes. Now what I've done is any row that is above this line, any row that is above this line will be freezed. Also, any column that is before this column J, that is from A to I, will be freezed. And you're in short, you're already seeing a line. You are seeing a line here. This is the freeze line. You're also seeing another line here. This is another freeze line. So it means that for this part, it will be freeze. So let's prove. Now, if I can scroll, I can continue to scroll to the end of the column. What I have here is still visible, isn't it? Are we good, sir? You understand what I've just done, sir?
Yes, yes, I do.
Yes, yes. So yes, I know you are familiar with that, but those that those that don't know how to do that will be able to learn when they are watching the videos. All right. So we've done common size analysis. The next thing we'll do is trend analysis. So we can quickly do our trend analysis. Yeah. So I will just bring this here. Trend analysis. So trend analysis, I want to know the change that has happened so far. That is what the trend analysis will do. The change that has happened so far. Now, the trend analysis, what I want to do is, okay, we are going to start from year 2 because we don't have any year before year 0. Year 1. We don't have any year before year 1. So we'll start our trend analysis on year 2 because trend analysis, what it does is it helps you compare what happened last year with what happened this year. So for year 1, we don't have last year for year 1. So, but we can start doing the trend from year 2. So we say year 2 equals to revenue in year 2 minus revenue in year 1 divided by revenue in year 2. So we can just put this in percentage. We can put this in percentage. Let me put this in brackets. I think Bodmas is working there. Bodmas is division first, Abi. So it has divided first, but I want it to subtract first before division. So yeah, so this is showing 7%. So my formula is working perfectly now. 7%. Now, we don't need to link this. We don't need to, how do I put it? Hold anything because I want it to automatically shift. Once I paste it here, I want it to shift. So let me come here and so it's now comparing year 3 and year 2. So this is good. So for trend analysis, I don't need to link anything. I don't need to hold. I don't need to use dollar sign to hold anything. I don't know if you understand my point.
Yeah,
So
I do, I do.
I just use it the way it is, like that. Yes. Okay, yeah, we don't have any figure here. This is 0. So I will just Now, this is an error. The reason why we're having this error is that the difference, the F10, research and development is 0. Anything divided by 0 is infinity, Abi.
Yes.
And if in short, if you divide error on your calculator, you'll be seeing errors. So that's an error. So that's a calculation error. Now, there's a formula on Excel that we call it if error. So if your calculation is 0, return it as blank. Return it as blank. So we use the if error formula there. So we say if error. So we are looking at the advanced aspect now. If error. So if this is an error, comma, what figure should it give us? So you can either put, okay, if it is an error, just put 0 and we are good. Just put 0 and we are good. So if you praise, yes, that our error sign is gone. But another thing, somebody else can be telling me that if I put in 0% here, it's okay. It's telling me that this 0% may not fully represent. Okay, this 0%, okay, it's still good because this is like 0. Research and development is actually basically 0% because it is 0. Yes, it is 0. But we can also say that, okay, return blank. So instead of saying return 0, you can say that if the value is error, return blank. Return blank by saying that, okay, you put double quotes, and in between the double quotes, you put a space in between. Or don't even put anything. Don't put anything between the double bar. So as you can see, this is now nil. So I can even replicate this formula. I can replicate this formula. I can replicate this formula down. I can replicate this formula down such that anywhere that there is no figure, instead of it to be giving me 0, it will just give it blank.
Yeah.
It will just
Give
give
it
me
blank.
blank.
Okay.
So if we didn't do this, I'm coming. If we didn't do this, if we actually did this, if we did this, if I press Ctrl C here, if I press Ctrl C using the first formula I use and press down and press Ctrl V, this is going to waste time. Oh, how long will this complete now? Okay, so this is showing me that this is an error, so many error. But I can quickly do this using the if error. So it's showing me so many error. Like for this empty, this one that is empty now, it's showing me error. But I can tell it that, okay,
Oh,
I don't have the time, just like what I did when we were doing this, that I have to do it for each of them. I'm saying, okay, instead of me doing it for each of them, if it is blank, don't put anything, just put a blank row. Just put a blank row. So that is why I would have to use this formula here, if error, and drag it down to the last stuff. So once I press it, automatically it only deal with where the formula is applicable. So any place that is supposed to give me error, it will just put blank space. That's the function of the if error. Now, the if error, let me explain the if error clearly now. Again, the if error is a formula that is telling you that, okay, you can put a value. The value is 5 plus 5. If the 5 plus 5 is not an error, good, calculate it. But if the 5 plus 5 is an error, I don't want to be seeing error in my report. So I'll say rather give me a blank. So blank, I can use double quotes to give me a blank. Then press enter. So this is 10. Now, if I say that 5 divided by 0, it's supposed to give me an error. Pi divided by 0. Let me bring this down. Pi divided by 0 is supposed to be an error. Coming. So I would say 5 divided by 0. This is supposed to give me an error, but because of this, my if error, I don't want to see errors in my report. So I said, if the formula is error, don't give me error. So rather give me a blank. Or I can even say, rather give me nil. I can tell it, give me nil. Anything I put in the quote will be typed nil. So give me nil. Or give me none. Give me none. So none. So that is how the if error works. So you're like, oh, you don't want to be seeing all those errors in your computation. So imagine if I say 5 divided by 0, it's showing me error, and I don't want to be seeing this error symbol. So I say, okay, instead of showing me this error, give me none. So that is how what the if error function is meant for. Do you understand that, sir?
Yes.
Or it seems like you already have an idea of this if error before now.
Not, not, not really. I, I've not. I don't think I've used it before, but I know the conditional something little, little.
Oh, okay, that's fine. Anyway, that's part of the reason why we are in this class. So that is a logical function on Excel. So if any if function is a logical, so you're telling Excel to carry out a logical test. So give me true or false. Yes, so logical test can be either true or false. All those things they did, normally give us when we were in primary school, continuous assessment, true or false. So that's logical. That's a logical reasoning. So yeah, so that is what Excel basically do. That is what Excel basically do. So we've been able to use the logical reasoning, if error, to be able to return our error to nil. So nil. Now, do you have any questions based on that, sir?
It's clearer now.
Okay, good. Okay, that's fine. So, I would share this document with us on the group so that what we have done today, we can also replicate it. These ratios that we have done before, I think we have treated these ratios before now, so that's why I'm not treating
Yes,
them
I've done
again.
this one before.
Yes, we've done all these ratios. So, but the reason why I wanted us to use this same sheet is to be able to solve the trend analysis and common size analysis. So yeah, so that is that. Our time is fast spent. Our time is fast spent. It's already almost 10. So I would be drawing the curtain here because I know that we have work tomorrow. Yes, we have work tomorrow. But if there are questions, okay, you said you are good. There is no question. Yes, those that will be listening to this recorded video, let's try as much as possible to be available in the next class so you can get value. Everybody that joined this class has actually made payments. So don't let your money waste. Get full value by joining the class. Imagine a lot of people that are not here, they paid though, but they are not here. So they're not getting the value. So please, that money you have paid, don't let it waste. Oh, you have to get benefits for the money. Yes, ask questions and all these things that you are learning, let's try to use it while we are working to make work easier for us. Yes, because this Excel is built in a way to make work easier for every one of us. Yes, so that is just that. All right, thank you. Thank you, sir, for coming on board.
Thank you very
Uh,
much. For,
yes, I would encourage you to be consistent, sir. Don't say, because I'm the only one today. Oh, no, next
no,
week,
no,
I
thank
don't
you.
think I will join. So let's just be here so that we can encourage others to also join. But I believe you've gotten a whole lot of value from the class, sir.
Sure, sure.
Oh, oh, okay, that's good. That's good. Okay, thank you so much, everyone. Thank you. Next week class will be more practical. Yes, thank you, sir. Bye for now, sir.